Alphabet just dropped 7% in a single day, and the smartest money on Wall Street says that's exactly the wrong stock to be scared about. I'm Alex Carter. Welcome back to Wealth Signal. This week, the tech sector got hit hard. Alphabet dropped 7%, and Tesla fell 13% after their earnings reports, and the Nasdaq opened down more than 1.5% on Thursday. If you're panicking right now, you're about to make the same mistake most investors made during the memory chip crash just 2 weeks ago. I sat down with the accounting research at Altimetry to understand what's really happening under the surface of these earnings reports. And what I found changes the entire story. If you want to actually understand where the smart money is moving instead of just reacting to headlines, hit that subscribe button before we get into it. Here's the roadmap for today. We're covering 3 stocks that could benefit massively from this sector rotation, and 1 stock everyone loved last year that you should probably stay away from right now. But first, you need to understand why this tech sell-off isn't the end of anything. It's actually the start of something much bigger. According to Altimetry's research, this earnings reaction misses the real story. Every single quarter for the last 3 years, hyperscalers have given CapEx guidance that the market says is too aggressive. And every single time, the next quarter shows massive data center revenue because they still can't build fast enough. Alphabet even said on its earnings call that it's still capacity constrained. And that's exactly why it went to SpaceX and xAI to buy extra capacity. This mirrors exactly what happened with Micron 2 weeks ago, when it dropped almost 30% before bouncing back hard once hyperscalers confirmed how much they're actually spending. Altimetry looked back at 3 decades of market data and found something important. The sectors leading a bull market never stay exactly the same from one year to the next. Last year's leadership was communication services, tech hardware, and industrials. Right now, communication services is stepping back while tech hardware and industrials stay strong. And a third sector is stepping into leadership: energy. Over 65% of U.S. market cap is now tied to AI in some way, and the buildout follows a clear chain. First, chips, then the power and cooling infrastructure, and finally the energy, natural gas and oil, needed to actually run all of it. There's also a geopolitical layer here. Tensions around Iran, the Strait of Hormuz, and the Red Sea have put a lasting premium on oil, and the U.S. needs a structural boost in natural gas both for AI data centers and for ramping LNG exports to allies. That means energy stocks are set up to be the next leadership sector, and that's where our first 3 picks come in. First up is Baker Hughes, ticker BKR. When you hear oilfield services, you probably think old school and boring. But Baker Hughes isn't just an oil equipment company anymore. It's quietly become one of the best-positioned plays on the entire AI energy buildout, benefiting from rising oil and gas investment, LNG expansion, and even direct work helping power AI data centers. Here's what's interesting. On paper, Baker Hughes looks like it's only earning a 5% return on assets, which sounds mediocre. But once you strip out the accounting noise and look at uniform accounting, the real number is closer to 15%, 3 times what the market thinks this company is actually earning. Now here's what concerns some analysts. This stock does move with headlines. It sold off earlier this summer on hopes the Iran conflict would resolve quickly. But even if that happens, the structural tailwinds here don't disappear. Even at $70 a barrel for oil and $2 to $2.50 for natural gas, Baker Hughes stays highly profitable because those levels still make U.S. drilling worth it. If this breakdown is giving you a different way to look at the tech sell-off, smash that like button. It genuinely helps this channel keep making videos like this one. Second is EQT, ticker EQT, the largest natural gas producer in the entire United States. Its shale wells across Appalachia have more than a decade of proven reserves at incredibly low production costs. And here's the real story. The U.S. is effectively the Saudi Arabia of natural gas, and that's a competitive advantage nobody else in the AI race can match. The average natural gas exploration company earns around a 5% return on assets. EQT, because its wells are so cheap and productive, earns closer to 10%. Add in the fact that U.S. power demand stayed flat for 2 decades and is now growing 20 to 30%, and you've got a company that could compound earnings 15 to 20% a year, while trading at a single or low double-digit price-to-earnings ratio. The honest caveat here, EQT isn't going to shoot up 1,500% like some of the flashier AI plays. This is a slower, steadier compounder, not a moonshot. But if you're looking for a durable way to play the AI energy story with real earnings behind it rather than hype, this is a name worth putting on your watch list. Before we move on, everything I've referenced visually in this video is saved as a downloadable summary file in our Wealth Signal Telegram channel, along with every past and future video's file. Links in the description. Go grab it. Third is Murphy Oil, ticker MUR, a true old-school exploration and production company, split roughly evenly between oil and natural gas across the U.S., Canada, and Vietnam. Murphy has spent the last 5 to 7 years quietly making smart bets in the Gulf of Mexico, Vietnam, and Côte d'Ivoire that are only now about to pay off. Those investments could potentially double Murphy's reserves, and the real catalyst is timing. The company expects to see a genuine surge in production as soon as the fourth quarter of this year, right as oil and gas prices are strengthening. That combination of low-cost production and a near-term output ramp is something the market currently seems to be sleeping on. The risk with Murphy is that it's more exposed to short-term oil price swings than a pure natural gas play like EQT. But if that fourth quarter production ramp plays out as expected, this could be one of the more explosive names on this list. Now let's flip completely, because not every stock benefiting from last year's trends deserves to keep your money. The stock to watch out for is T-Mobile, ticker TMUS. It had a great run over the last few years by taking home broadband customers away from Comcast with fixed wireless internet. But the market is currently pricing in T-Mobile maintaining its best-ever return on assets, without pricing in the competitive threat that's building against it. T-Mobile's return on assets currently sits at about 1.5 times the average telecom company, and that gap is exactly what's being challenged. Starlink is moving deeper into home broadband, which directly threatens T-Mobile's ability to keep taking share and raising prices. As that competition intensifies, analysts expect T-Mobile's returns to fade back toward the pack rather than stay elevated. So here's how I'd rank these 3 energy names. EQT first, for its pure natural gas exposure and steady compounding. Baker Hughes second for its diversified exposure across drilling, LNG, and AI power infrastructure. And Murphy Oil third for its higher risk, higher reward production catalyst coming later this year. And T-Mobile is the name I'd stay away from until this competitive picture becomes clearer. The bigger lesson here isn't about picking one magical stock. It's about understanding that market leadership rotates, and the smartest move is following where the real demand is going, not where the headlines are pointing. Right now, that demand is flowing straight into energy, and this rotation still looks early, not late. If you found this breakdown useful, drop a comment telling me which of these 3 energy names you're watching most closely. Hit subscribe if you want more of these accounting-based breakdowns, and share this with someone who's been panicking about the tech sell-off. And if you want the visual summary file for this video, join the Wealth Signal Telegram channel. Link is in the description. I'm Alex Carter, and I'll see you in the next one.